Okay, so welcome to our session on microfinance and rural banking in Ghana. In terms of the objectives, we're going to try to have an overview of microfinance institutions and RCBs in Ghana, discuss the contributions of microfinance to the Ghanaian economy, analyze microfinance programs in Ghana, examine the motivation for the establishment of rural banks in Ghana, and discuss the challenges confronting rural banks. In terms of the history of microfinance in Ghana, it goes back as far as 1955, where it is argued that the first credit union in Africa started somewhere in northern Ghana. Sometime later in 1962, the first formal microfinance institution in Ghana was established, and this was the Post Office Savings Bank. It later became the National Savings and Credit Bank in 1972. But prior to the conversion to the National Savings and Credit Bank, ADB was established somewhere in 1965 with a mandate to provide the needs of the fisheries and agri sector. A number of years down the lane, the first rural bank was established in 1976 in Agona near Krum. Now, somewhere after that, in the 80s, banks were required to lend 20% of their portfolio to agri and small-scale industries until the banking sector or the financial sector was liberalized somewhere in 1986. Suffice to add that even though banks were required to lend 20% of their portfolios to the agri and small-scale industries, this move did not necessarily prove very fruitful to the banks. In fact, a lot of the banks had quite some bad loans emanating out of that mandate, which then weakened the financial system, leading to the financial sector liberalization in 1986. Now, that actually then motivated the need to look at microfinance more critically. And after the microfinance sector started expanding, we have experienced some contributions from that particular sector towards the Ghanaian economy. We have the provision of working capital. Now, these institutions provide working capital to a lot of micro businesses, and then they have also aided in poverty reduction. They have created employment. There has been empowerment of women. It has also encouraged self-sufficiency and entrepreneurship. There has been capacity building, risk management and insurance, community development, as well as improvement in educational levels among the poor. Who are the people who provide microfinance services in Ghana? We can categorize them into three main groups: the formal providers, the semi-formal providers, and the informal providers. So for the formal providers, we have the typical commercial banks, savings and loans companies, rural and community banks, and then the microfinance institutions. For the semi-formal providers, we have financial non-governmental organizations, credit unions, and cooperatives. And we have informal providers such as Susu collectors, clubs, and associations such as the Roskers and the Accumulated Savings associations. Then we have traders, money lenders, and other individuals. So these are the providers of microfinance services in Ghana. Now let's look at the history of microfinance programs as well in Ghana. Somewhere in 2006, we had the Millennium Development Authority providing programs that focused on infrastructure, farmer and enterprise training, and post-harvest handling, etc. Prior to that, we had a support program for enterprise empowerment and development known as SPEED, which also sought to provide financial, technical, and business support to MSMEs. In 1998, we had the Social Investment Fund, the SIF, providing institutional and capacity building, human development, and socioeconomic investment. Then we also have the United Nations development programs that have focused on providing financial and non-financial services from selected microfinance institutions for micro-entrepreneurs, especially women. Now we have a number of institutions that seek to support that seek to support microfinance institutions in Ghana. We have top on the list the Microfinance and Small Loan Center known as the MASLOC, the Ghana Microfinance Institutions Network, Ministry of Finance and Economic Planning, the ministries, the departments, the Metropolitan, Municipal and District Assemblies, Bank of Ghana, and we have other institutions that support them like the universities, research and training institutions, development partners, international NGOs. So that's for the supporting infrastructure as far as microfinance institutions in Ghana are concerned. Now, when it comes to the apex bodies, those that normally put them together as one, we have the ARB Apex Bank that's usually in charge of all the rural banks, more like a mini central bank to rural banks. We have the Ghana Cooperative Credit Union Association, that's the apex body. Then we have Association of Financial NGOs. And then we also have the Ghana Cooperative Susu Collectors Associations. Now, these apex bodies normally work by providing a more unified code of conduct and other operational elements for the entities that operate under their wings. Now let's look at RCBs. RCBs here are rural and community banks. They are usually unit banks that are owned by members of a rural community through the purchase of shares. So when it comes to rural and community banking, it is practiced in places where mainstream banking or financial services are quite difficult to access. Now, RCBs are formed mainly to help improve economic activities in rural communities by addressing the problem of lack of finance and to increase access to credit. So in essence, the RCBs try to stand in where the mainstream commercial banks seem not to be able to reach. They perform financial intermediation roles in rural areas such as deposit mobilization, granting of loans, investment, and payment services. Now let's look at the management and structure of RCBs. So on the left-hand side, you can see a very simple organogram for rural and community banks. We have the board of directors that is responsible for steering the strategic direction of the RCB. And then there's a manager who reports to the board. Then there's a project officer. Then we have an accountant. And beneath the accountant is in charge of the cashier, the bookkeeping clerk, and the counter clerk. Then on the right-hand side, we have a more complex version where we have the board of directors, also in charge of the strategic direction. And then we have three elements or three offices coming directly under it. That's the internal audit, the general manager, and the secretary, typically to the board. Before we have the manager, and then the manager has the various operational units that would make for a normal organization, a normal banking organization. So you have the banking department with its agencies underneath, general central accounts, projects and credits department, IT, microfinance, general services department, currency operations departments, and then what have you. So you can have a very simple RCB organogram. You can have one that is more complex. It all will depend on size and capacity within that rural and community bank. Now, when it comes to the corporate governance of RCBs, corporate governance typically is the systems in place for directing and controlling the affairs of any corporate entity. So in governing or providing corporate governance for RCBs, we have the board of directors, and then there are a number of committees, subcommittees of the board that see to it that the right things are done and the right directions are taken. So we can have the finance committee, the local loans committee, welfare and human resource committee, marketing and deposit mobilization committee, strategic planning committee, assets and liability management committee, and then the audit committee. So these are some of the subsets of committees that can work within the governance framework of RCBs to see that it's successful and profitable. Now, RCBs typically must source for funds to be able to provide the relevant services or intermediation services to the rural community in question. In sourcing for funds, they would fall on deposits, shareholders' equity, undistributed profits, so that will be more of retained earnings, borrowings, government support, and international agencies support. When it comes to how they make use of funds, the funds go out through the granting of loans, when they invest in securities, when they make social investments, when they acquire fixed assets and infrastructure, when they make the payment of dividends, or they make the payment of interest. Now, RCBs are not without challenges. In fact, in seeking to provide these financial services to rural communities, they also have challenges. Some of the challenges are non-performing loans, in the sense that the loans are not paid back and they are usually going bad. Then they also struggle with poor performance. Now, this is normally linked with the non-performing loans together with other systems, such as weak human resource capacity, because RCBs in general are operating within the tertiary industry, or tertiary sector that relies more on the skill set of the human resource capacity. So where you find that the human resource capacity is weak, then it translates into poorer performance, and that poorer performance is also linked to a large extent to the core business of granting loans, so which then become non-performing. Also linked to the weak human resource capacity may be internal controls. And then on the broader front, we could have a lack of clear regulations. Then they also have challenges of poor service delivery, and then also the issue of location and ownership requirements. So we have gone through the basics of the microfinance and rural banking sector in Ghana, and want to look at the elements that you should have in mind even as you review and revise this lesson. You should be able to discuss the contributions of microfinance to the Ghanaian economy, evaluate the various microfinance programs that have taken place in Ghana, and then also be able to discuss the challenges confronting rural and community banks in Ghana. We'll move on to look at the impact of microfinance. In general, remember that microfinance evolved as a way to meet the poor in terms of their financial needs, their financial service needs. So to be able to know whether or not it has delivered on that mandate, there's a need to do an impact evaluation, an assessment. And then in the same vein of typical management, when you release resources for use in any particular area, for you to know whether it's being done right, then there's the need for you to do an assessment or monitoring evaluation. So the learning objectives under this particular session will be to discuss the challenges involved in impact evaluation and current approaches that have been employed, explain reasons why microfinance largely focuses on women, explain why women are seen as better customers for microfinance, and outline key findings and conclusions of research on the impact of microfinance. One of the first issues to understand for impact evaluation is the need to ask the question, why do we need to assess the impact of microfinance? Now, impact assessments usually evaluate long-term outcomes. What it means is that you want to find out whether the program, because microfinance provision is a program, what has been the long-term outcome? Has it delivered? Has it failed to deliver? Why has it not delivered? Or why has it delivered? And what are the lessons that can be learned from it? Now, the importance of assessing the impact of microfinance, because it helps the providers to understand the effect of their services on client welfare. It also helps funders to understand the impact of their investments. And it also helps policymakers to adjust policies and make the relevant budget decisions. But of course, assessing impact can be very challenging. Challenging because no microfinance programs lend to randomized or random citizens. So it means that what it really means is that because it's not a random frame of just giving out loans and seeing impact, is the real impact what you pick as impact can be a confluence of so many factors, because for somebody to even qualify for a microfinance loan, they would have met certain characteristics. Now the question would be that, are the characteristics the reason you are seeing an impact, or you are seeing an impact because of the microfinance? And then also because what makes clients different is not necessarily measured. So if there are differences in terms of age, educational elements, and whatnot, we do not measure them before we give out loans. So being able to determine whether or not it is the age and educational status, for example, of a client that is affecting the impact of a loan facility on their lives could be very different. So then there are other things that you can also cannot measure. Things like the entrepreneurial spirit of a person, somebody having better business connections, or being more focused, etc. So what seems like an impact of getting access to credit truly maybe in fact reflect what we normally refer to as unobservable attributes or what factors. Now, in measuring impact, there's a possibility to use what we call randomized controlled trials. Now, randomized controlled trials, or what we call RCTs, they are one of the few methods that can account for selection biases and unobservable factors. Now, this is how randomized control trials work. You try to identify two subgroups that are as similar as possible in a lot of ways, so that we can say that the groups are identical replicates, or they are identicals. Then you're going to provide the microfinance facility maybe, or the program, the intervention, to one group and then not to the other group, so that at the end of the period, the group that did not experience the program would have evolved to a certain stage. And then the group that also got the intervention, the microfinance facility, for example, would have evolved to a certain stage. And then you are able to measure, based on whatever factors you're using, the difference between group without the microfinance facility and then the group with the microfinance facility. That, in a sense, helps you to determine what the real benefits of the microfinance facility is. Now, for that reason, you make sure that the control and treatment groups are selected randomly, so that the households or the entities in the different groups are equivalent on average on relatively all observable factors, or observables as we call them, educational levels, entrepreneurial skills. As much as possible, they should be identical, so that by doing that, you're able to uncover the net impact of the intervention, free of what we refer to as the selection bias. However, we sometimes use these experimental methods only to estimate the average impact of assessing services or interventions. So, of course, if the sample is large enough, then we can disaggregate the data into subcategories to see impact on different groupings. So let's say those who have education but not this, those who are old but not that, so you can have them. But then there are cases where sometimes there are spillovers even when you're doing randomizations, for which reason sometimes it becomes even quite difficult to measure real impact. Because let's say one person benefits from the loan facility. Upon buying their seeds or whatever, they give some, or they even lend some of the money they received to somebody who was not supposed to be part, or who wasn't supposed to be part of the study. Now, when that happens, it means that somebody who was not supposed to participate, in essence, has indirectly participated. So now there are spillovers. Or in this case, spillovers arising from the fact that whatever benefit one entity is experiencing somehow spills over into a larger community benefit. So that can also give challenges sometimes to measuring their real impact. Now, RCTs are usually still, but very good ways of getting an estimate of impact of services like microfinance. But then the results may be very difficult to generalize to other settings. So somebody may ask, why does microfinance focus on women? Microfinance focuses mostly on women because these groups of people are generally neglected in economic activity, although they make about half of the world's population. In general as well, it is known that women tend to work for longer hours and are less paid compared to their male counterparts. And then when it comes to the formal sector service providers, they seem to focus more on men as they tend to run larger businesses and control assets that can be used as collateral. For this reason, in the quest to provide or help alleviate poverty, microfinance seems to favor mostly small enterprises in the informal sector, where women account for a large fraction. Another reason why women are focused on more is because they tend to be more credit constrained than men and are likely to select themselves into microcredit schemes. And also because women lag behind in many key indicators of economic development. Also, relatively to men, women in low-income countries face far greater social, legal, and economic obstacles. So microfinance is somehow seen as a road to gender empowerment. Now, the question therefore, if we are focusing on women, can we say that the women better customers? Now, women are generally more conservative in investments, for which reason they pose a lower risk in terms of default to lenders, and this is supported by Aguirre and Shafar's 2013. Evidence has also shown that women are better at repaying loans. You can look at Kandkar et al. And Despalier et al. Then we have Kevan and Wydig, who find that female borrowing groups in Guatemala misuse funds least often as compared to men, so that there was a chance that if there was going to be misused, it was more prevalent among the men than it would be prevalent among women. And lending to women may have advantages for the financial institutions and may enhance efficiency in the broader economic sense. Looking further into the question of whether women are better customers, we do realize that women are poorer than men and have less access to capital than men. So under the neoclassical production function, the returns to capital for women should therefore be higher than men. So endowing women with more capital can thus be growth enhancing in principle. And usually women are more fearful of social sanctions than men, and so they are prone to be better customers. Now, women are also quite less mobile than men, so are likely to live and work in or near the home. So loan officers and bank managers can therefore monitor women at a lower cost, because less mobility facilitates delegated monitoring under group lending methodology. And then lower mobility also reduces the incidence of strategic default under the fear of social sanctions. Now, whilst focusing on women, does microfinance necessarily empower women? Advocates actually argue that microfinance can increase women's bargaining power within the household, in a sense, by providing them with microfinance facilities and therefore enhancing their potential business capacity, they increase their bargaining power within the household. Now, also because peer monitoring in group borrowings may act as a deterrent against domestic violence and abuse. Also, rising household incomes in general can also diminish conflicts between husbands and wives by loosening financial constraints. However, not all academics agree on the effect of microfinance on women's rights. Now, how does a microfinance affect the household in general? Microfinance does affect household outcomes through a variety of channels. Microfinance may make households wealthier, push up their consumption levels, improve their health, their children's education, and leisure. But because running micro enterprises may also take time, yielding substitution effects that may counterbalance the effects of what increased income. So only evaluating impacts on business profits, for example, may thus miss out on other important changes within the household. So in essence, to be able to do a proper assessment, you need to take a more holistic approach without just focusing on one side. Now, micro lenders may also make direct non-financial interventions that affect client outcomes. Some programs actually use meetings with clients to advise on family planning and to stress the importance of schooling and good health practices. So even though there's a financial aspect, the non-financial interventions also aid in affecting or contribute to affecting households in the area of microfinance. The multiplicity of channels means that it is typically impossible to assign a given measured impact to the strictly financial elements in MFIs. For this reason, we can say that much could be learned by gauging the impacts of business training, marketing, and other interventions that are sometimes delivered alongside financial services. Now let's look at some evidence from Sub-Saharan Africa. So Stewarts et al. 2010. They reviewed 15 studies, 4 randomized control trials, 2 non-randomized control trials, and 9 case studies. And they say that microcredit has mixed impacts to incomes of poor people, but micro savings has no impact. Microcredit and micro savings have positive impacts on levels of savings and accumulation of assets. Both have generally positive impact on the health of poor people and on their food security and nutrition. So holistically, there's something good to be derived from microfinance. They go on to say that evidence of the impact of microcredit and micro savings on education is varied. There's limited evidence for the positive effects and more evidence that microcredit may be doing harm to education. There is some evidence that microcredit is empowering to women, but not consistent across review studies. And both microcredit and micro savings have a positive impact on clients' housing. They go on to say further that there's little evidence that microcredit has any impact on job creation. In summary, both microcredit and micro savings have the potential to improve the lives of the poor, but microcredit in particular has potential for harm. Micro savings may therefore be a safer investment for development agencies. Now, the reason that microcredit is tagged as having a potential for harm is because by taking on the microcredit, a number of these beneficiaries end up sometimes taking on too much credit, which then gets them into a debt trap and can actually worsen their case than previously was the case when they did not have access to credit. So then some actually posit that we should focus more on micro savings than rather maybe on microcredit, or that there should be a very delicate balance between the two. The reason being that some people are made poorer and not richer by microfinance, especially microcredit clients. This because they consume more instead of investing in their future. Their businesses fail to produce or yield enough profit to pay the interest rates. And the context in which microfinance clients live is by definition very fragile. In terms of some of the conclusions as well, there is evidence that microfinance enables poor people to be better placed to deal with shocks. The emphasis on reaching the poorest of the poor may be flawed because it's not getting it right. And micro savings may be a better model than microcredit, both theoretically and based on available evidence. And then the evidence on micro savings is small, and further rigorous evaluation is needed. Let's sum up by reviewing what we have done so far. One, we have learned why evaluating the impact of microfinance is important, and also look at some of the challenges whilst also assessing the merits of randomized controlled trials. Also look at why microfinance largely focuses on women, why women are seen as better customers for microfinance, and also to be able to discuss the key findings and conclusions of research on the impact of microfinance. This brings us to the end of this session, and I will encourage you to read more on the assigned text to situate yourself within the discourse of microfinance, its impact evaluation, and that of rural and community banks as